So have you dared to look at your investment account lately? If you have, you probably felt that little pit in your stomach. I mean, the headlines are just screaming disaster, right? But what if I told you that all this fear, all this panic, is actually a smokescreen for one of the biggest wealth-building opportunities you'll see for years? Today we're going to tune out the noise, look past the panic, and see what the cold, hard data actually says. All right, let's get into it.
To really get what's happening now, we need to jump in a time machine and go back to the last time it felt like the financial world was ending. I'm talking about March 2009. There's this story about two investors that just perfectly captures the exact choice that we're all facing today.
So picture this. You've got two people, they're both 27, same job, same salary. They each managed to scrape together $5,000 to open their very first investment accounts. And they do it in the exact same week, which happens to be at the absolute bottom of the financial crisis. The market had just cratered 57%. People were losing their jobs left and right. The news was just a constant stream of disaster. So naturally, they were both absolutely terrified. Okay, so investor number one, he looks at all that red on his screen, he sees the terrifying headlines, and he does what feels completely logical. He thinks, this is nuts, and he pulls everything out, moving it all to cash. His plan? Just wait on the sidelines until things, feel safe again.
Now, investor number two, he's feeling the exact same fear. His stomach is in knots, his brain is screaming, sell, sell, sell. But he made a plan. He was going to invest $500 every single month, no matter what. So he just gritted his teeth, ignored all the noise, and he stuck to the plan.
So let's fast forward to 2020. How did things turn out for investor number one, the guy who played it safe, who waited for things to feel certain? Well, his initial $5,000 grew to about $18,000. I mean, it's not nothing, but it's not exactly life-changing either.
And investor number two, the one who kept his cool and just kept investing right through the panic, his account grew to over $210,000. Think about that. Same start, same money in. The only difference was that one decision he made during that very brief, very scary window of maximum fear.
And that brings us right here to today. It's the same kind of scary headlines, the same gut-wrenching fear, that same feeling that maybe this time it's different. We are standing in that exact same window of opportunity. So the real question isn't about the market, it's about you. What will you do?
So why does everything feel so shaky right now? Let's take a quick look under the hood and break down exactly what's got everyone so spooked.
It already kicked off in a flash. Late February 2026, military strikes start. By the beginning of March, the Strait of Hormuz, which is a huge deal, it's where about a fifth of the world's oil passes through, it gets shut down. And the result? Bam! Oil prices just exploded, from $72 a barrel to $118 in 1 month. That is a massive shock to the global system.
And the market did what the market always does. When it's faced with big uncertainty, it totally freaked out. The S&P 500 had its worst quarter in years. The NASDAQ tumbled into what we call a correction. And just look at this. The CNN Fear and Greed Index, which is basically the market's heartbeat, plunged deep into extreme fear. Readings this low are incredibly rare. We've only seen them on about 3% of all trading days since 2011. That's how thick the panic is right now.
All of this has created one big, scary story that you're hearing everywhere. It's the boogeyman of stagflation. The idea is that this oil shock is going to cause massive inflation, which will force the Fed to crank up interest rates, which then kills economic growth. It's the absolute nightmare scenario from the 1970s that took over a decade to climb out of. That is the bear case.
Okay, so that's the fear. That's the story. But is it actually true? Let's do something radical. Let's ignore our feelings for a minute and just look at what a century of cold, hard data has to say about moments just like this one.
The whole "we're repeating the 1970s" idea kind of falls apart when you look at the facts. Back then, inflation was already screaming past 10%. Today, it's sitting at 2.7%. Unemployment was at 9%. Today, it's just 4.2%. And here's the biggest one. Back then, the US was totally dependent on foreign oil. Today, we're one of the biggest producers on the planet. I mean, it's not even apples and oranges. It's more like apples and car tires. The underlying economies are just fundamentally different.
And what about the conflict itself? It feels catastrophic, and it is on a human level, but purely from a market perspective, history tells a very different story. Researchers look at 20 major military conflicts since World War II, and they found that, on average, the stock market was fully recovered in just 28 trading days. That's less than 6 weeks. Think about that. The rebound was basically over before most people even felt safe enough to dip a toe back in the water. And if we zoom out even further, the picture gets even more clear. Over the last 100 years, the average bull market, so when things are going up, has delivered a gain of 177%. The average bear market loss? Only 35%. The math here is just overwhelmingly on the side of the optimist. The upside you get from staying in the game has historically just crushed the temporary pain of the downturns.
And now for what might be the single most important number in all of investing. And I want you to really let this sink in. In the entire history of the S&P 500, if you invested for any 20-year period, any of them, you would have made money. 100% of the time. Through world wars, the Great Depression, pandemics, you name it. A perfect track record.
So if the data is this clear, if it's this overwhelming, why do so many smart people get it wrong? Why do we sell at the exact worst moment? Well, the answer isn't in an economics textbook. It's actually inside our own heads. It all boils down to this weird glitch in our brain's programming called loss aversion. Study after study has shown this. The pain you feel from losing $100 is psychologically about twice as powerful as the joy you feel from gaining $100. It's a survival instinct, right? It was great for keeping our ancestors from being eaten by tigers, but it is perfectly designed to make you a terrible investor. It just hijacks your logic and makes you want to stop the pain no matter what.
And this mental glitch, it has a real-world price tag, a huge one. Over the last 30 years, the S&P 500 delivered an annual return of over 10%. But the average investor? They only saw a return of 3.66%. Where did all that money go? That giant gap is the panic tax. It's the cost of selling low during times like this and buying back high when things feel safe again. It is literally the difference between a comfortable retirement and not.
And here is the ultimate knockout punch. This stat from JP Morgan is just wild. The vast majority of the market's absolute best days, the huge, explosive days that generate most of the long-term returns, they happen during the bear market or right at the beginning of the new bull market. So if you sell and you're sitting on the sidelines waiting for the all-clear signal, you're almost guaranteed to miss the very days that matter the most.
Okay, so let's bring it all home. We've seen the story, we've looked at the data, we've peeked inside our own psychology. It all boils down to the decision that's right in front of you, right now, in this moment.
You're really at a fork in the road here, with 3 paths. Path 1, you sell. You wait for things to feel safe. But as we've seen, that almost always means you lock in your losses and you miss the rebound. Path 2, you do nothing. You just hold on, which is way better, but you miss the chance to really accelerate your gains. And then there's path 3. You keep investing. You lean into the fear and use it as a chance to buy great companies while they're on sale.
And this requires a huge mental shift. You have to reframe what's happening. This isn't a crash, it's a clearance sale. You're not losing money on paper. You're accumulating shares at a huge discount. Just think about the math. When the market is down 40%, every single dollar you invest buys you 67% more of that asset than it did before the drop. That's the powerful, simple arithmetic that builds serious wealth in times like these. And so that brings us right back to where we started. The calendar says 2026, but it might as well be March of 2009. The choice is identical. The headlines are screaming fear. The data is whispering opportunity. That window, it's open right now. So the only question left to answer is, which one of those 2 investors are you going to be?